Is the AI boom still sustainable? The short answer is no, not at this price. The massive cash-burning machine is finally hitting a wall. While tech giants pour hundreds of billions into chips and infrastructure, the actual profits are shockingly low, and the bond market is running dry. If you want to know if we are on the verge of a historic dot-com-style tech crash, watch this video until the end. Global stock markets have been turbulent lately. AI hardware technology stocks, once seen as money-printing machines over the past year, have suddenly become ATMs for major institutional investors, leading to sharp pullbacks across technology-heavy indices. This sudden reversal in market sentiment may stem from potential tightening of monetary policy by global central banks, prompting capital to re-examine earlier investments. Investors are realizing that the monetization of large AI models is far slower than expected. Once the growth of capital expenditure in the industry slows down, the extremely high valuations of hard tech may become unsustainable. Since 2025, tech giants have been aggressively raising cash in the bond market, but recently that well seems to be running dry. Amazon's ongoing sale of $25 billion in bonds required offering prices cheaper than the secondary market, yet the oversubscription rate was only 1.6 times, a relatively cold reception compared to high-grade credit issuance earlier this year. In February, Google's parent Alphabet and Oracle issued $20 billion and $25 billion in bonds, with subscription ratios of 4.7 and 4.2 times, respectively. Amazon's March issuance of $37 billion also drew 3.2 times coverage, but market response has declined month by month since. For instance, SpaceX's $25 billion bond issuance last month saw only a 2-times subscription rate. The bond market is becoming saturated with AI-related debt, and its capacity to absorb more is weakening. According to Bloomberg statistics, global AI-related debt issuance has reached $335 billion this year. Tech giants are raising funds relentlessly. Amazon and Alphabet have each pulled about $100 billion from the bond market over the past 18 months. This is the reality of the second half of the AI arms race. In the first half, cloud giants relied on cash flow from existing businesses to fund investments, but the AI revolution has sent most of that money into the pockets of semiconductor companies, forcing tech giants to turn to the debt and equity markets. For the first time ever, the free cash flow of hyperscale cloud providers, including Amazon, Google, Meta, Microsoft, and Oracle, has turned negative, marking a major historical turning point. Meanwhile, the free cash flow of the semiconductor industry, driven by NVIDIA, Micron, Broadcom, and Applied Materials, has surged to over $400 billion. There was a time when the market was obsessed with the AI concept, and any business tied to it attracted enthusiastic investors. The growth of hard tech companies primarily benefited from the massive infrastructure spending of global AI giants. But after spending fortunes, the actual revenue generated from AI has fallen short of expectations. Market forecasts indicate that the total capital expenditure of the 4 major U.S. tech giants, Microsoft, Google, Meta, and Amazon, will soar to approximately $725 billion in 2026, a 77% surge from about $410 billion in 2025. Amazon alone plans to spend $200 billion, a figure nearly equal to its total spending over the previous 3 years combined. Goldman Sachs estimates that from 2025 to 2030, the cumulative AI capital expenditure of these 4 companies will reach $5.3 trillion. However, the industry's revenue growth from AI is far from matching this massive scale of investment. Microsoft, for example, saw its annualized AI revenue run rate exceed $37 billion in the first quarter of 2026, a surge of 123% year-on-year. Yet, compared to an annual infrastructure investment exceeding $100 billion, the rate of return remains a drop in the ocean. In recent years, global AI giants have engaged in an arms race that effectively barred weaker players from entering. However, the emergence of Chinese tech companies has significantly lowered the entry barrier for large models. DeepSeek V3, for instance, had a total training cost of only about $5.57 million. Compared to the hundreds of millions of dollars typically spent on OpenAI's ChatGPT, this is a mere pittance, yet its performance reaches over 90% of top-tier models. With lower training and electricity costs, Chinese large models can capture the market with much lower pricing. The inference fee per million tokens is as low as a few tenths of an RMB, significantly cheaper than OpenAI's rate of several dollars. If large models become cheap commodities, the economic viability of Silicon Valley giants spending tens of billions of dollars annually for just a few percentage points of performance improvement becomes highly questionable. Furthermore, slow adoption at the downstream application level has left large AI models in an embarrassing position, where they sound omnipotent but deliver limited practical results. Despite being viewed as a technology that could change the world, many companies have found after actual testing that aside from helping write emails and summarizing meeting minutes, very few enterprises can truly use AI to make money. Interestingly, while AI previously threatened the jobs of IT engineers, a reversal is now underway. Companies that previously conducted massive layoffs are starting to rehire. CFOs looking at the numbers are discovering that the cost of AI tokens is shockingly high, making human labor more cost-effective for certain tasks. According to recent surveys by research firms like Gartner and McKinsey, as enterprises upgrade AI from simple chat interactions to autonomous agentic AI capable of executing tasks, token consumption is exploding exponentially. In some cases, a single development team can generate monthly token bills reaching tens of thousands of dollars, directly approaching or even exceeding the salary of a senior engineer. When automation becomes a more expensive recurring expense than human labor, enterprise CFOs begin to calculate carefully, advising boards that certain tasks should be handled directly by highly skilled employees, rather than letting AI endlessly consume tokens. U.S. tech giants are raising massive amounts of capital in the bond market, while bond prices stagnate. While this hasn't triggered a full-scale tech stock crash yet, the most direct and fatal trigger for a sell-off could come from the macro level. Federal Reserve meeting minutes noted that the AI arms race is pushing up inflation, placing it alongside tariffs and energy crises as one of the three major drivers of inflation. Rate cuts are off the table this year, and rate hikes could soon be on the agenda, just as tech giants are draining their operating cash flows. Various signs suggest that no matter how strong the demand for AI infrastructure is, it cannot overcome the reality of a cash shortage. The growth in demand for memory and GPUs may be approaching a deceleration threshold. The Federal Reserve has historically elevated strong demand for AI infrastructure to the level of an inflationary driver. This contradicts the view of the new chairman, Kevin Warsh, who has consistently emphasized that AI would drive supply-side prosperity and improve productivity, potentially acting as a major disinflationary force. Officials pointed out that at this stage, AI investment-driven economic growth could lead to more persistent inflation. The Fed's team of economists has pushed back the timeline for core PCE inflation to return to the 2% target to around 2028, indicating a longer road ahead for fighting inflation, with more officials believing interest rates should be higher than the current range. History shows that companies that burn through cash during a capital expenditure boom rarely recover their costs. From the telecom industry in 1994 to the shale oil industry in 2014, suppliers selling the shovels at the peak of the capital expenditure cycle made massive profits. However, these peak revenues usually do not become the norm. Customer spending discipline eventually returns. A worst-case scenario could resemble Cisco in the past. Before the dot-com bubble burst, during the internet boom from 1995 to 2000, Cisco spent tens of billions of dollars to acquire over 40 companies in just 2 years to expand its capacity and technology reserves to meet endless orders for routers, averaging one acquisition every 2 weeks. In March 2000, Cisco's market value surpassed $550 billion, overtaking Microsoft as the world's most valuable company, with a forward PE ratio exceeding 100 times. By early 2001, dot-com companies that relied on venture capital burning or heavy debt went bankrupt one after another. Surviving enterprises aggressively canceled orders, some of which were speculative bookings based on imaginary prospects. Cisco's order book emptied rapidly, and in the third quarter of that year, it announced a $2.2 billion write-down for excess inventory. These state-of-the-art routers and switches, with no buyers left, essentially turned into scrap metal. Whether the same story repeats depends on how much liquidity remains in the market to sustain the cash burn of these tech companies. Once cash flows break down, even issuing debt becomes difficult, and the final straw that breaks the camel's back will undoubtedly be a rate hike. Failing to stay alert after reading the Fed minutes would be a serious oversight. Bubble bursts are never announced in advance. even if history repeats itself with striking similarity. Lacking a massive and stable application ecosystem to monetize, most large models currently survive solely on financing. As global monetary policies potentially tighten and investors turn cautious, the disproportionate investment and return in the AI industry are being questioned. The market is waking from its dream, and the high pricing logic of hard tech is gradually failing. AI will shift from hyping concepts to looking at earnings. In this process of valuation reshaping, significant stock price volatility is inevitable. The direction of the U.S. stock market will depend on how management handles astronomical capital expenditures when tech companies report their earnings over the next few weeks. The era of hyping up AI concepts is officially over, and companies now have to show real financial results. With massive capital expenditures and tightening central bank policies, the next few weeks of earnings reports will determine if this bubble completely bursts or finds its footing. This leaves us with the ultimate question. Do you think Silicon Valley's multi-trillion-dollar AI bet is going to pay off? Or are we repeating the 2000.com crash? Let me know your thoughts in the comments below, or cast your vote in the channel poll right now. And see you in the next video.